What's up guys, welcome back to my channel. My name is Nick and I talk all about trading and investing here on YouTube. Today I've got a topic that I really love to talk about, and it's kind of a touchy topic when it comes to trading and investing, because there's a lot of different viewpoints and a lot of different opinions about what kind of trading returns are realistic versus achievable versus unrealistic when it comes to trading and investing. So today I'm going to give you my response, my opinion on what I think realistic trading returns look like for somebody who is actively trading or a person who is more passively investing. So stay tuned, let's get into it. All right, so trading returns are a very heavily debated topic. Some people are out there saying you should shoot for 100% per year. Some people are saying 10% per year is not bad. You're gonna have all different sort of opinions out there, and I'm gonna share with you mine because I think it very much depends on your perspective, your situation, and very important, your risk tolerance. So let's go ahead and first start by scratching this one right off the board. This topic here, dollar per year versus percent per year, is something we need to talk about. A lot of times people say, well, how much money can I make trading? We hear that so often from beginners here on the channel. I get that comment probably once a day or once every few days for sure. How much money can I make from trading, Nick? People say all the time. Well, the dollar amount that you can make per trading is very much going to depend on how much capital you have, how much risk you're willing to take, and other various factors. But for the most part, what's more important is not talking about dollar per year, but rather talking about the percentage that you are going to be going per year. And notice I said per year. I'm not talking about trading returns in the next 3 days or 5 days. You know, I'm personally not a big fan of trying to flip an account or trying to be very quick to make a bunch of money in the currency exchange or stock market. That's just not how I personally have gone about it, and I've never had any sort of success trying to be a super short-term, you know, flipping accounts, making a lot of money like that. I've never even known somebody who does that consistently. So that to me is not even on the table. But today we are talking about percentage per year, what is realistic? Now again, there's two main factors in terms of how much dollars you can make per year. That's going to be depending on how much money you have and how much risk tolerance you have as well. If you're more risky, you can definitely make some bigger returns, but you're going to be risking more money. So what's realistic percentage per year? This one is heavily dependent on your personal risk tolerance. If you're somebody who's in and out of the S&P 500 with large lot sizes compared to your account, and you're looking to scalp big profits short term, you could definitely return a lot more than somebody who's going to be passively investing or somebody who is trading with very small position sizes. Now, it's all going to come down to your reward, or your trading returns are going to come down to the amount of risk you are willing to take, like I'm saying. So the returns of somebody who is risking 1% on a position, right? If you're risking 1% on a trade, your results are going to be drastically different than somebody who is risking, right, 5% on a trade. Now, it may not be well known to a lot of the newer traders out there, but if you're risking 5% on a trade, you're risking a very large amount of your capital on every trade. Because let's think about something, roughly, if you took 5 losses in a row, which trust me, it happens, and if you haven't had it happen to you, it will happen soon. Losing 5 trades in a row happens. But if you were to take 5% risk on a trade 5 times in a row and it lost every time, the numbers are not exact, because if you're risking 5% each time and your capital goes down, it's going to decrease the amount that you're risking in terms of dollar amounts. I don't know how to say that exactly in terms of, but if you look at the math, basically, if you were to risk 5% of the account 5 times, right, and lose all 5 of those, let's just say you have a losing streak, that's going to be 25% of the account. If you were to bet, let's say $100 each time and you lost at $500, that would be, you know, on a $10,000 account, that's a decent, that's actually only just 1%, but whatever 5% is, that's going to be a pretty substantial drawdown. Now, it's not actually going to be 25%, because again, the way the math works out, if you were risking 5% each time, this would be more like 4.5 7.5% and then 4.5% of your initial capital. But just for simplicity, the point is you're gonna have a rather big drawdown in a short period of time, risking 5% per trade. However, your reward could be huge, because let's say that you risk 5% and then you take a loss and then you take a big win. Let's say you take a 3R trade and it profits. You just made 15% on your account. So suddenly you have this very, very big, massive gain. You got 10% added to the account in a short period of time. So it is gonna come down to the tolerance of risk you have. So if you're risking 5% per trade, the upside is much bigger, but so is the downside. You could very easily blow an account risking 5% per trade if you took something like 5 to 10 trades in a row that ended up being a loss. Now that's why a lot of times you hear people saying risk something, like 1% of the account, because in the case of risking 1%, right? If you were to risk 1% and you lost 5 trades in a row, it's gonna be a much less drastic drawdown, right? Here you go, you take 5 trades in a row, that's gonna be a 5% roughly drawdown. That's not terrible, and a lot of times that's rather recoverable. When you get into the drawdowns that are like 30%, now you're talking you need a lot of returns to get back to normal. In fact, if you were to be down by 50% of your account, what does it take you to get back to your initial account? It's not plus 50%. A lot of times new traders, they don't really think about it this way, but if you go from a $1,000 account down to $500, that's a 50% drawdown. What does it take you to get back? It takes you $500 on your $500 account, right? Because your account is now just $500. To get back to $1,000, it takes you a $500 gain, which is a 100% gain. So when you lose capital, you're losing the ability to get back to your money easily, right? It becomes harder and harder the bigger your drawdown gets. So that is something that is very, very dangerous, and a lot of times new traders don't think about, and that's why risking 1% is so important in my opinion. Now, I'm gonna add on to that. A lot of times people don't like to hear that you should just risk 1% because the gains or the trading returns, which is what this video is about, are going to be not massive. If you have a good year, you might make 20%, 30%, 40% on a really good year, risking 1%. Now, it also depends how frequent you're gonna be trading. Are you taking 3 trades a day or 4 trades a day and you're a short-term trader? If you're really good, you might be able to make 40%, 50%, maybe even more in a given year if you are really on edge and you have really, really good entries and exits. But for the average trader, to me, I'm gonna share with you what I personally go for, what I think is realistic, and I'm just gonna erase the board and we'll take a look at that. All right, so now that we've talked a little bit about risk and about what returns or what kind of drawdowns there would be with different levels of risk, I think it's time to actually talk about the upside. So we've talked about some of the downside, some of the drawdown that you might face trading with a 5% risk versus trading with a 1% risk. What kind of returns could we expect? Let's say, for example, that you have a trading strategy that you usually go for 2-to-1 reward to risk, meaning that when you win 2, and when you lose 1. Well, what if I was to say you only won 50% of your trades, okay? Well, if you have a 50% win rate, okay? Let's say you've gone through the time and the effort required to get to a point where you've found out how you can make proper entries, you look for the right things on the right time frames and the right charts, whatever you do in your trading strategy. And let's say you have a 50% win rate and your winners are 2 times bigger than your losses. Well, if you took 100 trades, let's see how it plays out. Let's say you take 100 trades and you're risking $1. So you're risking $10 to make $20, right? In that case, if we took 100 trades, how is this gonna play out? Let's say that you're a swing trader and in the course of a year, you make 100 trades, okay? That's like a trade every few days. And remember, the markets are not open every single day. So if you took 100 trades and you risked 10 to make 20, this is how it's gonna probably play out. So within that 50%, you're gonna have 50 winners and 50 losses, okay? Just by the fact that we've got that 50% win rate, right? Well, if we win 50 and we make 20 times each, $20 each win, what is that? So 20 times 50, well, that is going to be $1,000 in profits, okay? And then if we were to take 50 losses at $10 a piece, 50 times 10, we lose $500. And if we're risking 1% on the account, then that is going to be a $1,000 account. So we have a $1,000 account, right? So our $1,000 at the end of this year goes from $1,000. We see we have a overall profit when we factor these two in of plus $500, okay? So that means that in the course of this year, we went from $1,000 plus the $500 to $1,500 on the account, okay? That is a 50% gain in the entire year with only risking 1%. Now this is a very, very good performance. Not everybody's gonna be able to get 50% wins with a 2-to-1. If you are, that's really, really good, and long-term, that's gonna suit you really well. So to me, 50% in a year, that's not bad at all. We made $500 on our $1,000 account, and the next year, we could even compound that and start fresh. And that's really the power of doing this long-term, is you take those gains and you rinse and repeat and you start fresh and you add more capital, and long-term, the capital starts working for you more and more. So this is kind of my opinion. If you're risking 1% per trade, if you're very good, you could make something like 50%. And for me, I'm shooting for something like 20 to 30 to 40% per year, depending on the market that we are in. Because that's finally, when it comes to trading returns, another very important variable is how volatile is the market that you're trading. Because if things are not really moving, for us shorter term traders, there's sometimes not as much money to be made. It depends your strategy, of course. But if you're like me, I'm looking for trends to try and capture a piece of. That is going to be dependent on if the market is trending or not. So some years I'll have better returns. Some years I will not have as good returns, but I'm looking for an average of 20 to 30% per year. Now that is going to change depending on the year. And so some years you might have plus 50, some years you might have plus 10, some years you might have minus 5, some years you might have plus 60. You have to look at this stuff from a super long-term perspective, in my opinion, because if you want to be a trader, it is a lifelong journey to improve and to build consistency in. So that's my thoughts on trading returns, guys. I hope this was helpful to you, and if it burst your bubble a little bit, I hope it was in a way that was not didn't bother you too much. Sometimes people get really mad when I say, I'm not shooting for something like 200% returns. Maybe there's traders out there that can do it, but I've never seen one with a track record that can prove it long term. So, it is what it is. That's just my honest opinion, guys. Thanks so much for watching. I hope you got something out of it, and we'll see you back in the next video.